Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It is 2026, July 17th, and today the market looked at the AI trade and said, politely, absolutely not.
The AI party finally found the bill under the couch cushions, and apparently the bill included chip stocks, Nasdaq futures, copper, Bitcoin, and everyone's emotional support spreadsheet.
Story 1. Bloomberg reports chip stocks are leading a sell-off as investors question AI assumptions. Nasdaq 100 futures tumbled 1.5% as traders rushed out of positions that powered this year's rally but had become expensive.
Simple version. Imagine AI stocks are a luxury gym membership. Everyone signed up in January, nobody asked the price, and now someone noticed the sauna is still under construction.
Exactly. The finance behind it is valuation versus earnings timing. If companies spend billions on chips, power, and data centers today, investors need proof that revenue and profit can catch up tomorrow, not in the year 2047 when my toaster has a venture fund.
But wait, weren't we supposed to be happy because inflation is cooler? The New York Times says cooler inflation may still not stop the Fed from raising rates later, which feels like ordering a salad and still getting charged for steak.
That is the second story. The Fed is expected to hold rates steady at its July meeting, but officials have not ruled out a move soon after. Cooler inflation helps, but if growth, wages, or financial conditions stay too strong, the Fed may worry inflation can reheat.
So for normal people, this means mortgage rates, credit cards, auto loans, and small business financing do not magically become cheaper because one inflation report behaved itself. One good report is not a personality transformation.
Story 3. CNBC reports Chinese startup Moonshot AI unveiled its Kimi model, claiming it rivals OpenAI and Anthropic. For markets, this matters because competition can compress the pricing power investors had assumed for leading AI companies.
I slightly disagree with the panic there. Competition can hurt margins, yes, but cheaper models can also expand usage. It is like coffee. Bad for the fancy cafe charging $9, great for the sleep-deprived population trying to function.
Fair reversal. More competition can grow the pie, but it changes who gets paid. That brings us to CXMT. South China Morning Post reports the Chinese memory giant's Shanghai IPO was oversubscribed 212 times online, with more than 9.4 million investor accounts applying.
212 times oversubscribed is not demand. That is a stampede wearing brokerage app sneakers. But investors should remember, a hot IPO can signal strategic importance, not guaranteed future returns.
Final market spillover. Bloomberg says copper followed stocks lower as the AI sell-off deepened, and CoinDesk reported Bitcoin slipping below $63,000 as risk appetite weakened. When tech, crypto, and industrial metals all wobble together, it suggests investors are reducing exposure broadly.
Translation for your portfolio. Check concentration risk. If your investments, your job prospects, and your dinner conversation all depend on AI chips going up forever, you may not have a portfolio. You may have a fan club.
Actionable takeaway. Rebalance rather than react. Keep cash needs separate from long-term investments, and watch 3 signals: Fed language, AI earnings quality, and whether sell-offs spread beyond tech. This is not personal financial advice, but it is a reminder that growth opportunities work best when paired with risk controls.
And if today's market made you sweat, do not panic scroll your brokerage account like it owes you an apology. Subscribe to BD Daily Finance News Podcast, like the episode, and tell us in the comments, is this an AI bubble popping or just a healthy reset?